Hello all. So when the market crash happens, most of the people get panicked because we don't know whether to stay invested in those companies that we have in our investment portfolio, or should we just cut losses and move out. So in order to avoid such confusions, I have created a 3-point checklist which can be acted like a stress test for your portfolio and the stock holdings that you have. So here is what you need to do. Take out your portfolio, go through, create an Excel or some sheet, and take each business, run through these three checklist items, run through these three stress test items, which, and if your business comes through successfully unscathed through all of those three checklist points, it means that you're good to stay through the course in the business and you don't have to get out of that stock immediately. Now, if any of the factors fail, it means that it could be an alert, an indicative direction that you need to move out of that stock irrespective of how much the fall is. If you have made a mistake, it's better to cut the weeds and keep moving and look at reinvesting in any other stocks in your portfolio that has the sturdy stability in terms of visibility of earnings and everything. So, look at evaluating your portfolio businesses or stocks through these three checklist items and determine, whether to stay through or move out of those companies. Example, there could be companies which are having, no potential growth in the near term future, and they might not be having enough capital to withstand. It's just an indication that you need to move out of such companies. Let's get into this more in detail. So here is a simple checklist with 3 points that needs to, you need to evaluate or stress test your stocks if it can sustain sudden exogenous economic shocks like what we just saw in 2020. So most important thing is how much cash does the company or the business carry in the balance sheet. This is because the cash can absorb, you know, the sudden shocks in the economy like the 9/11 shock, or any unprecedented events, black swan events. 2020 corona crisis was virus crisis is one such black swan event. Whether your investment portfolio can withstand these kind of sudden shocks, absorb those shocks and keep moving, that's what we want to evaluate. So look at how much cash does the balance sheet carry, and the cash in the balance sheet is important because it'll help the fund, it'll help the business fund the near term working capital deficits due to the recessionary environments. So the near term working capital crunch is the most common thing that can happen or that can arrive out of such kind of shocks. And whether the company can sustain the near term working capital needs for the next 2 months, 3 months, 6 months is what you need to evaluate. So how much cash does the balance sheet has, and how much of that cash can withstand how, what kind of period in the foreseeable future, assuming that economy would bounce back after 6 months or even 3 months. Now, that's first checkpoint. The second one is avoid businesses that carry high debt profile in the balance sheet. A highly leveraged business not only cannot sustain near-term capital needs, but it'll also have to sacrifice the debt during the tough times when the businesses doesn't have revenues or cash flow. The debt servicing becomes difficult in such kind of crisis situations. So one can look at debt to equity ratio, which is a most standard ratio used. It's an ideal ratio would be around zero point 0.5 during these kind of times. One can also look at interest coverage ratio to see how the business is placed to service the debt or service the debt through the interest payments. So the ratio is calculated very simple by dividing the company's earnings before interest and tax, that is EBIT, by the company's interest expense for the same period. So if you have interest period, so it just shows like as a ratio how much percentage of the company's earnings uh, has to be serviced, with the respect to the interest expenses. So it's a good ratio to look at, and high interest coverage ratio means that the company is in a better shape to service the interest over the next few months or few quarters. So the high debt profile is something that needs to be really looked upon. Most of the companies that go bankrupt, belly up during these times are the companies that have high leverage, unable to service the debt, and file for bankruptcy. So it's a very simple thing to look at. Some of the companies might still be having high debt, but may be able to cover that debt with interest payments or refinance through better deal in the capital markets or in the credit markets. And so one cannot just look at one absolute ratio of debt to equity. That's why I'm saying look at the earnings potential. Can they continue to get cash flows and still service the debt and withstand the test of time the next at least foreseeable future? Do they have good profile in terms of credit rating in the market? Can they get their debt refinanced and restructured if possible? So those kind of things has to be assessed too. It's not only an absolute ratio of debt to equity. The third point is cash flows, which is the lifeblood of businesses, and having high operating and free cash flows are imperatives of good businesses. So one should look at a close look at how much is the receivables outstanding for the businesses you are invested in, because stressing times can have your customers default on the payments or create delinquencies on the payments, which can impact the cash flows of your businesses. So a highly profitable and growing companies doesn't translate to balance sheet strength, and they can fade out during these testing times. So because a highly profitable company can still go bankrupt, because all those profits doesn't translate to cash flows. I know, because it is more of profits on the recognition. It's paper profits, it's not cash flows. And your customers having high receivables can put you at high risk exposure. So you can even go, people, you can go deep. Many of your customers can go default, not pay, ending up paying the receivables. So high receivables is to be evaluated. Similarly, high payables for your own balance sheet is not a good sign. You might end up being in choking times, ending up taking huge debt to pay if there is a huge pressure from collections. So all of these factors has to be looked upon. So cash flow has to be, the whole cash conversion cycle has to be looked upon. And whole in the during in that cycle, how much of the high inventory pileup has to be evaluated. All of this has to be looked upon and see that the company can sustain this next 2-3 quarters of economic recession. So these three factors, if you look at and evaluate, and if your company comes unscathed or successful out of these three testing conditions, it just means that your investment is fine and good to hold on for the foreseeable future. But if all three aspects, any one fails, you need to determine more, do more causal study to see where it's failing in the supply chain. And need to be worried if the failure is really genuine. So and look at reevaluating your investment percentage allocation. You could prune the allocation, you can do multiple other things within the portfolio, but it's a good strategy to evaluate, especially during such crisis situations. Hope this checklist was helpful. Thank you.